What if the worst day in the market was secretly the best day to invest? Orovale, a neon metropolis where every district pulses with financial energy. From the crumbling Borough Badlands to the gleaming spires of Compound Heights, money is the city's lifeblood, and its rules reward the patient. Those neon lights aren't just decoration. Orovale's aesthetic traces directly to Art Deco design, a movement that fused economic ambition with visual spectacle in the early 20th century. Capital and light have always traveled together. Dollar cost averaging, DCA. You invest a fixed dollar amount on a regular schedule, regardless of whether the market is up, down, or sideways. Same amount, same day, every time. That's the whole mechanism. Most people picture wealth building as buying at the bottom and selling at the top. That fantasy has a name: timing the market. The data is brutal. The SPIVA scorecard, published semi-annually by S&P Dow Jones Indices, shows that over 15-year periods, more than 80% of actively managed funds underperform their benchmark index. Professional fund managers with billion-dollar research budgets can't reliably time the market. Then the crash hits. Orovale's Compound Heights index drops 40% in 6 weeks. Citizens freeze their investments. They pull money out. They wait for the storm to pass. This is the moment most investors lose, before the recovery even begins. Ledger does the opposite. While the city panics, he pulls out his investment schedule and smiles. A lower price means every dollar he invests today buys more shares than it did last month. The math doesn't care about the sirens. The mechanism in plain numbers. A share of Orovale Index Fund costs $100 in January. You invest $100. You own exactly 1 share. February arrives. The crash hits. That same share now costs $50. You invest your same $100, and now you own 2 shares. The crash just doubled your purchasing power without you changing a thing. March. The market partially recovers. Shares climb to $75. Your $100 buys 1.3 shares. Over 3 months, you've invested $300 total and accumulated 4.3 shares. Your average cost per share, $300 divided by 4.3 shares, roughly $69. Someone who put all $300 in during January paid $100 per share. You're already ahead by $31 per share. Same money, better position. The counterintuitive twist. A longer, deeper crash is better for a DCA investor. More months at low prices means more shares accumulated cheaply. The storm isn't the enemy. The storm is the sale. The historical record backs this up without ambiguity. Vanguard's research on investor behavior shows that individuals who maintained consistent contributions through every major downturn, including the dot-com crash and the 2008 financial crisis, outperformed those who paused or tried to time their re-entry. The data isn't a close call. Consistency beats timing across every measured cycle. But here's where it gets psychologically hard. Every instinct screams stop. The news is catastrophic. Neighbors are selling. The Borough Badlands fills with citizens who cashed out at the worst possible moment, locking in their losses permanently. Locking in losses is the real killer. A share that drops 50% needs to gain 100% just to break even. The 2008 to 2009 S&P 500 crash. The index fell approximately 57% from peak to trough. Investors who sold at the bottom and waited on the sidelines missed the subsequent 300% recovery over the next decade. A fair challenge. Does DCA still work if the market never recovers? It's a real question, and it deserves a straight answer. DCA depends on long-term growth trends. It's not a shield against a permanently failing asset or a fraudulent market. This is why DCA pairs with broad, diversified index funds, not single stocks. Broad markets reflect the collective productivity of entire economies. Over any rolling 20-year window, diversified market indexes have delivered positive real returns. Consider Las Vegas in the 1940s and 1950s. As capital flooded in and the economy expanded, neon signage exploded. Fremont Street became known as Glitter Gulch because neon density tracked investment density. Urban historians use neon concentration as a literal proxy for capital accumulation in a district. Oroville's glowing skyline isn't metaphor, it's a documented pattern from real economic history. Scale matters less than consistency. Using a 7% average annual real return, the historical long-run average for U.S. diversified equity indexes is approximately a 6.69% average annual real return. An investor contributing $200 monthly starting at 25 accumulates roughly $500,000 by 65. An investor contributing $400 monthly but starting at 35 accumulates roughly $488,000 over the same endpoint. Starting a decade earlier with half the monthly amount still wins. This is why Oroville's wealthiest residents live in Compound Heights. Not because they earned the most, but because they started earliest and never stopped. Compounding rewards time in the market more generously than it rewards timing the market. What about the investor who started DCA 1 month before the worst crash in Oroville's history? Terrible timing, right? Historical analysis shows that even an investor who began a consistent DCA program in October 2007, 1 month before the S&P 500 began its catastrophic decline, outperformed the investor who waited on the sidelines until the market felt safe again. The crash that followed their first investment gave them months of cheap share accumulation. By the time the market recovered, their average cost was low enough that the recovery pushed them into strong positive territory, faster than anyone waiting on the sidelines had imagined possible. Financial literacy programs like Fintropolis, a Minecraft world built to teach investing through real-world scenarios, use exactly this kind of simulation. They show that understanding the mechanism, not just the outcome, is what builds durable investor behavior. The most powerful feature of DCA isn't mathematical, it's behavioral. Automating contributions removes the emotional decision entirely. You never have to feel brave enough to buy during a crash, because the system already bought for you while you were sleeping. That democratization matters. DCA doesn't require a fortune to start, a Bloomberg terminal to monitor, or an Ivy League finance degree to execute. It requires a fixed amount, a schedule, and the discipline not to flinch when Oroville's alarms start blaring. Waiting on the sidelines carries its own tax, inflation. Idle cash loses purchasing power every year. The investor sitting in cash, waiting for the perfect moment, isn't playing it safe. They're slowly losing ground while the market, imperfect as it is, moves forward. Here's a number that should stop you cold. According to J.P. Morgan Asset Management's annual guide to retirement, an investor who missed only the 10 best trading days in the S&P 500 between 2003 and 2022 ended up with less than half the wealth of someone who stayed fully invested the entire time. 10 days out of nearly 5,000. Remember that opening moment, Oroville's crash alarms blaring while Ledger grinned? Now the grin makes sense. He wasn't reckless. He was informed. The crash wasn't a catastrophe for his portfolio. It was a clearance sale on his future. Every documented market cycle delivers the same verdict. Vanguard's long-term investor studies and the SPIVA scorecard point the same direction. Investors who tried to time their entries underperformed consistent DCA contributors by a significant margin. The data doesn't hedge. Consistency wins. 3 steps. Pick a broad, diversified index fund, a total market fund like Vanguard's VTSAX, or a low-cost S&P 500 index fund. Tracks thousands of companies in a single instrument. Set a fixed monthly contribution you can sustain without strain. Automate it so it runs regardless of headlines. That's the entire system. Complexity is the enemy of execution. Here's the part nobody talks about. DCA is deliberately boring. That's not a flaw, it's the design. Research on investor psychology consistently shows that the more actively investors monitor and adjust their portfolios, the worse their outcomes. A strategy you set up in 20 minutes and then largely ignore outperforms one that demands constant attention. Oroville's neon lights may flash and flicker during a storm, but Ledger's terminal just keeps quietly buying. So, What if the worst day in the market was secretly the best day to invest? It's not a secret at all. It's arithmetic. And arithmetic, unlike timing, never panics.